hit record. We're going to make sure we record this for everybody. So if you're not with us tonight, we are going to be recording and making sure that everybody has access to this who bought tickets, and we'll make sure everybody has access to the information. So today is a very special night. We're all very excited about real estate investing at Sutton Summit Real Estate, and very happy to be joined here today by Gord Lemon with a very exciting topic for us to discuss tonight. So Gord, thank you very much for joining us, and the floor is yours.
All right, thank you, David, appreciate it. So let me ask everybody this. How would you like to be independently wealthy? And by that, I mean having enough money coming in every month to cover your regular monthly bills, and without you having to do any or very much work to achieve this. Would this provide you more choices in life? You know, most families work hard, put in a lot of hours at work, and are away from their families just to pay their monthly bills. That's real life for most people. But today I'm going to show you a way to create passive income, spendable money that shows up every month for you to pay your bills or go on a trip or do whatever with. So welcome to 7 Steps to Building Wealth Through Real Estate Investing. I'm your host, Gord Lemon, on behalf of the Real Estate Training Club. And I commend you for being here to learn about how you can change your financial life forever. And I also want to thank Sutton Summit for inviting me to share with you tonight. And I wish to thank every realtor here that has invited you onto this webinar. So now, I've been a huge believer in real estate for decades, and most people have heard this quote by Andrew Carnegie that 90% of millionaires have become millionaires through real estate. And if you check around with the millionaires on your contact list, I'm sure that you will concur. Oh, and if you don't have many millionaires on your contact list, well, if you actually want to become a millionaire, you need to surround yourself with other millionaires. And according to this, at least 4. And to do this, you need to learn to do what the rich do, and then naturally become a millionaire yourself. And many millionaires have used real estate either as part of what made them rich, or others have become rich solely through real estate. Now, Armstrong Williams says, the one thing I tell everybody is learn about real estate. Real estate provides the highest returns, greatest values, and the least risk. And today I'm going to show you in 7 steps of how to make this a reality for yourself. Now, you might be asking yourself, who are you? Now, and what qualifies this Gord guy to show me how to build a real estate business? So, and there's only going to be a select few of you that actually understand the reference here. But would it be okay if I provided you a quick history and then we'll jump into our topic?
Of course.
So I had actually a lengthy career in professional music as a studio musician, composer, and producer. Made a pretty good living in the Toronto area for many years, but I sensed pretty early on that on the music business that I knew was not going to exist for the long term. I didn't know at the time that the advent of digital recording, a new invention when I started my career, would be a huge contributing factor leading to the significant and almost complete demise of the industry. But I knew I needed backup, and certainly if I was going to have financial freedom that I desired, I needed some backup. So in my early 20s, I began actually speculating in Mississauga, buying single-family homes, which I flipped to an end buyer as I couldn't qualify for a mortgage because I was, a long-haired musician. So after a couple monumental wins, I actually got caught in the real estate crash in Toronto that happened in the late 80s. And I lost all my profits and then some. And then I took some well-needed real estate investment training. And long story short, I've been an active real estate investor in both Canada and the US now for over 32 years. And I've been involved personally in over $50 million worth of residential and commercial real estate in multiple niches using multiple strategies. I have been a real estate agent. I was a mortgage agent for over 12 years. And I've been a trainer in real estate investing for 17 years, which I love to do. I've written a few books, and I've also written over 30 articles. You might know this magazine. It's Canadian Real Estate Wealth magazine, and a couple in the Rain Report. But at the end of the day, doing real estate deals and growing my portfolio is my passion. And, you know, there are at least over 50 niches in real estate investing, and way too much to get into here. And just to let you know what I mean by niches, I first want to clarify the two types of investors who invest in these types of niches. So similar to stock investing, real estate has two investor types: investors and traders. And I'll tell you what I mean about that. A trader typically holds a property for a short period of time. And in real estate language, they basically do flips. And their technical analysis is generally a type of flip formula, which enables the trader to determine their short-term profit, their capital gain over their short holding period. And due to the nature of the short holding period, flippers typically need to be way more active and involved in the market to find more deals in order to perpetuate these short-term gains. Consequently, they need to buy, renovate, and sell quickly to make their maximum profit and then be out on the hunt for the next project. So here are a few trader niches. So first we have the aforementioned buy, fix, and sell or flip, which is buying for the purpose of renovating the property and selling as soon as possible for a quick profit. And then a related one, which we commonly see, is the tear down or infill property. A much longer flip, if you will, as the permitting process can take a while in some municipalities. And of course, the physical process of actually tearing down an existing property and rebuilding is much longer than just renovating an existing property. But other trader niches are land, and by that, not for the purpose of holding land, but rather the strategy of buying land with the express purpose of changing the zoning to a higher and better use, and then selling that property to a developer or builder. And then we have land assembly. Now, this is buying multiple properties from a number of adjoining homeowners or buying adjoining parcels of land, changing the zoning, and then selling that to a developer or builder. And next we have condo conversion. And this is the process of taking an apartment building with multiple doors under one title and changing the building to have multiple titles and then selling each unit separately, kind of like buying by the mile and selling by the foot. And lastly, we have wholesaling. And this is a process of tying up a property, not actually buying it, getting an accepted offer on a property, and then selling the contract, if you will, for a small profit to another investor who closes on the deal. Now, next we have the investor. Now, the investors hold for a longer period of time. They do a fundamental analysis on their deals to ensure the property will be profitable in the present and in the future over time. And consequently, each property investment is a more positive cash flow investment, more passive, and is set for long-term growth. So essentially the investors do a buy and hold for long-term wealth. So here are some typical long-term hold niches, which are used for cash flow and long-term wealth, beginning with a single family home, or commonly a single family home with a suite. The next one is kind of a new titled strategy called the BRRRR strategy, which means buy, renovate, rent, repeat, refinance, and repeat. And this can be done with any property type, but most commonly taking a single family home, renovating it, often adding a secondary suite, and then refinancing the property because the value of the property is much higher than, to pull out a good chunk of the initial capital used on the acquisition and renovation, sometimes all of the money. Next is multifamily residential. So renting a property with 4 doors and under, which qualifies for residential financing. Anything above 5 doors essentially becomes more under the commercial lending umbrella. And then there's an underutilized strategy called rent to own, which is a sort of a midterm hold, which helps tenants actually buy the property from the investor over time. And of course, we have student rentals or the resort property like an Airbnb. Now, there are definitely other niches in the long-term hold, which is more on the commercial side. of renting. So we have mobile home parks, we have self-storage, we have medical buildings, we have parking lots, we have hotels or motels, we have commercial retail spaces, office, industrial, warehouse, and assisted living. And believe it or not, a lot of investors move from the residential type of investing and then ultimately move into this type of investing over time. Now, this purpose was not meant to overwhelm you by any stretch, but rather to provide you some insights into the depths of real estate investing. So step one for you to begin your real estate journey is to pick one particular niche, one strategy, one property type, and one geographical area, and become both an expert in that strategy, but also become an expert in the area. Now, what do I mean by that? So you can work with the realtor who brought you here tonight to understand the best place for you to actually buy, say, a rental property. Now, to understand the viability of the area, you must look at some basic market fundamentals, such as the local economy. And real estate, as you know, is local, and some areas will be better than others for investing, right? Next, just really being confident and understanding the local real estate prices and what the historic appreciation has been over time. And then understanding what the rental demand is and understanding the rental amounts in that area. And of course, understanding the property expenses associated with properties that say might be a 1-bedroom or a 2-bedroom or a 3-bedroom, either in a condo or a townhouse or a single family home, right? So getting acquainted with all of these different types of prices. And remember, you don't need to know everything in the beginning. Just pick one strategy, one geographical area, one property type, one area, one property type, and go all in. And I have to tell you, early in my investing career, I made the mistake of being open to multiple strategies. And I basically instructed my realtors to send me any type of property that they thought would make money. And consequently, what happened was I was spending tons of time looking at lots of deals, figuring out whether it was a good flip or better for a rental or a rent to own or whatever. And I wasted a lot of time doing that rather than focusing. So your focus will make you an area expert, and it'll allow you to identify good deals way faster and be able to determine if the property that's in front of you is actually a deal or not a deal, right? Now, many investors focus on rental properties, which over time build their portfolios and consequently their fortunes. And rental properties can be thought of like, like little oil wells, which produce money for you every single month. And the more oil wells that you have, the more money is going to go into your bank account on a monthly basis for you to do with as you wish. And when you have enough money going into your bank account monthly to match your monthly expenses, guess what? Boom, financial freedom. Now you have more choices in your life, right? Now, step two is understanding the real estate profit centers. And this is an amazing aspect of real estate. The beauty of rental properties is the number of profit centers or wealth generators, which are actually built into each property and which work together to create profits for you. Now, just to be clear, the stock market generally has one profit center. Now, buying a stock at one price and selling it for a higher price is basically the method of making a profit. And yes, I understand there's shorting a stock and some stocks do pay dividends, but generally most stock investors rely on the one main profit center. In real estate, there's actually 7 profit centers, particularly when it comes to rental real estate, which is what we're talking about at the moment. And just to get the most obvious one out of the way, the first one is natural appreciation, one you're very familiar with if you are a homeowner. So this is a natural occurrence in the market, which has been happening for decades. And as a note, smart investors never, I repeat, never rely on natural appreciation as the only profit source, as most, say, condo speculators do, but rather enjoy it as the cherry on the sundae on top of their other profit centers. So let me show you some of the other profit centers. Now, of course, property values go up and down over time, as seen here in this graph of Toronto real estate prices over the past 65 years. Generally, they go up over the long run, as the straight trend line suggests. So the next wealth generator is forced appreciation. Now, forced appreciation, as mentioned just a few moments ago in the BRRRR strategy, where we buy, renovate, rent, refinance, and repeat, is buying a property in the need of some TLC or creating, say, an additional suite in order to bring the property value up, and then immediately, say after 4 or 6 months, refinance that property based on the higher value. The next wealth generator is leverage. Now, leverage is the ability or opportunity to put down a smaller percentage of money to acquire the property, as the lender puts up the money for the rest, but the investor benefits from all the profit centers. So to be clear, the bank will lend you money to buy property, but they won't lend you money to buy their own bank stock. Just saying. The fourth profit center here is cash flow. Now, some people say cash is king, but they're wrong. Cash flow is king. Cash flow is the spendable money in your jeans left over after the mortgage and expenses are paid. This money comes in every single month, month after month, year after year, like all those little oil wells. And you can spend it on paying other bills, going on vacations, eating in nice restaurants, whatever you choose. It's your profit. The fifth profit center is mortgage paydown. Now, mortgage paydown is one of the most overlooked aspects of rental real estate, but it is one of the most significant. With each mortgage payment, there's a principal amount and an interest amount, and I'm sure you're used to that with your own mortgage on your home. The interest amount is the bank's portion, and of course, the principal amount is the owner's portion. So with every mortgage payment, there's an ever-increasing amount of ownership for the investor, also known as equity. But here's the best part. In your own home, you're the one on the hook to pay the mortgage and create that equity on your own. In rental real estate, your tenants are the ones paying for the mortgage, creating your equity. The sixth profit center is refinancing. Now, as the equity through mortgage paydown occurs, and coupled even with a small amount of appreciation, an investor can then go to the bank and refinance the property, thereby securing a new mortgage based on the higher property amount, thereby enabling the investor to receive back some or all of the original capital used for the initial acquisition. And then use these recoup funds to do what? Well, buy more property and repeat this process over and over. And finally, the seventh profit center is tax advantages. A little less sexy than the others, but there are many tax advantages when it comes to owning investment real estate. And the government appreciates investors who provide housing to the public and therefore reward them by allowing them various tax incentives and write-offs. Please check with your tax professional on this always. But at the end of the day, it's not how much money you make that's important, it's how much you actually keep, right? Now, step 3 in our 7-step process is understanding the real estate cycle and kind of where you are in it. Now, let me ask you a question. Do you think you have to time the market to make a profit? To only look to get in at the bottom of a cycle, like say in 1965 or 1985 or 1997? So in order to have done very well, can you see that if you bought a property basically anywhere in this timeline and just rode the wave, you'd be doing well, right? Conversely, do you think if you needed to sell a property, do you need to sell at the top of the market like in 1974 or 89 or 2017? Well, I can tell you, you don't have to buy at the absolute bottom and you don't have to sell at the top to make incredible profits. But understanding what is happening in your local real estate cycle can provide you some insights on selling and buying, but also potentially on refinancing. And I'll actually get more into that in a moment. Now, at the end of the day, one of the skills you need in our step 4 here is understanding how to analyze rental property. Now, I briefly touched on that a moment ago, but in a rental property, it's important to understand how to determine whether a property will actually make money for you. In other words, understanding how much cash flow will be produced from the property on a monthly basis. So the income's generated, obviously, from rental income from the tenants. Now, this is obvious when renting a unit, but there's other potential income sources, such as renting the garage separately, renting out a shed, renting out other areas of the property for storage, or getting laundry income even, right? So there are multiple areas to make money. And then, of course, there are the expenses, which are mortgage and property taxes and insurance, and sometimes utilities. Sometimes the tenants pay for it, other times the landlord's paying for it, but it's important that you know what those are. And then a condo fee or an HOA fee. And then we have smart investors use a vacancy reserve fund, and it's generally a portion or a percentage of the gross rental income that's coming in. And as well, having another account, if you will, for a maintenance reserve fund. So when you incorporate those into your process, you are actually building up reserve funds. So if the property goes vacant for a month, you have a vacancy reserve fund to cover the balance of any expenses that month and not have to go into your own pocket. And if there's any maintenance issues, you're building up a maintenance reserve fund. So when you understand these amounts and do your calculation, the outcome needs to be positive cash flow. Now, this leads us to the next step, which is understanding the power of even owning one investment property. And I'm going to show you the power of that. So I'm going to do that through an example. And I found just lately, I found a triplex on realtor.ca. The realtor who brought you here this evening will be able to supply you definitely some good rental properties for you to look at. So after this, please inquire about that. So here's an example though. This property is a triplex in Hamilton, so 3 units. There is 2 2-bedroom units. Oh, sorry, 2 2-bedroom units and 1 1-bedroom unit. And you can see it's listed for $549,900. And we're not even going to negotiate that for our example here. So without going into a huge property analysis lesson, I just want to show you this example to prove an amazing aspect of the power of real estate. So let's do some quick and easy real estate math. And believe me, most real estate math, or almost all of it, is easy. So I went to Kijiji in Hamilton and found the average rental of a 2-bedroom unit in a property like this was $1,800 per month. And because there's 2 of them, we multiply that by 2 and we get 3,600. And then there's a 1-bedroom apartment unit with this. And so that was $1,250. So in this totaled $4,850. But I want to be conservative and even round this down to $4,500. How's that? So we're going to use $4,500 as our income amount. So we've got a purchase of $549,900. And when we put 20% down, which that's the minimum we have to do as a non-owner occupied property, that is $109,980. And so that leaves a mortgage balance of $439,920. And we're going to use a rate of 3.5%. Right now you can do a bit better than that. And we're going to use a 25-year amortization. And that created a mortgage payment of $2,196.69, which for the purposes of easier math, I'm rounding up to $2,200 a month. Okay, so we have $2,200 for our mortgage payment. Property taxes, according to this listing, were $4,500, so that's $375 a month. Insurance, $125 a month. Utilities, yep, we're going to pay utilities in this instance, $1,000 a month. And we're going to incorporate, well, because it's not a condo, there's no condo fees. And we're going to calculate, based on our $4,500 a month income, 5% of our vacancy rate. So we're going to start building our vacancy reserve fund using 5%, taking away 5% and dropping $225 a month in a separate bank account for our reserve fund, and similarly with our maintenance fund. So we've created two different bank accounts that we're just putting away 5% of the gross rental income. And so when we incorporate all that, that's $4,150 of expenses every month. So easy math here, monthly income minus monthly expenses equals $350 positive cash flow a month. And that's $4,200 annually. Now that's spendable income for you. And that goes a long way towards a week in Mexico, you know, just saying. So check this out. So our initial investment, of course, we put our down payment down of $109,980, but we've got land transfer tax of $14,945. Let's say the conveyancing fees, i.e. the legal part of you know, when the lawyer registers title in your name or your company's name, that's $1,600. We did an initial inspection, $750. And let's say we put $7,725 of renovation costs into the property just to make it a lot nicer looking. Our total initial investment, $135,000. Now, I want to show you the power of real estate here. So this is where it actually gets really fun. So to outline the columns here, column 1 is the total amount at the end of each year. And you'll see what I mean by that. Column 2 is the annual positive accumulating cash flow based on $350 a month, positive cash flow. Number 3 is the new mortgage balance paid down, right? So at the end of each year, this is what's going to be revealed here. Number 4 is the equity accumulated from that year. And so this is the result of subtracting the new mortgage balance from the original mortgage balance. And number 5 is the equity and cash flow. So column 2 here, added to column 4 to get the sum that will be shown in this column. And then number 6 is the ROI. Now this is going to be dividing the equity and cash flow into our original total investment of $135,000. Okay, so let's see how this rolls out. So the first year, we have a total of $4,200 in accumulated cash flow. The new mortgage balance is $438,729, giving us an equity amount. So what's been the principal pay down has been $11,251. And that's all your increasing ownership in the property. And the best part is the tenants have actually paid this for you. How cool is that? And then when we add the cash flow and the equity amount, we get $15,451. And when we divide this amount into our initial $135,000 investment, we get, we get 11.45%. That's first year. So I just want you to reflect on if you have any mutual funds or anything, how they're doing. Are they paying you 11.45%? So second year, and I'm not going to reveal each one, but we get accumulated cash flow of $8,400, our new mortgage balance $417.82, giving us a total equity amount after 2 years of $22,898. Our equity and cash flow amount $31,298. And so this obviously the ROI builds over time. So now on your $135,000, we get 23.18% return on investment. So going to year 3, $12,600 of a monthly of positive cash flow, new mortgage balance $405 and $24, giving us total equity of $34,956, equity and cash flow $47,556, and 35.23%. Then we have Fourth year, 16,800. New mortgage balance, 392,539. Equity of 47,441. Equity and cash flow, 64,241. And the ROI is 47.59%. And finally, after year 5, $21,000 accumulated cash flow. New mortgage balance, 379,614. Equity of 60,366, $81,000 in equity and cash flow, and that's 60.27% on your $135,000. So that's not too bad. Oh, and let's not forget, we had a reserve fund of $225 a month, right? Our vacancy reserve fund, over 60 months, that's 13,500. That's been just growing there. And if you didn't use it at all, and remember, you fixed the property up at first, so tenants are less likely to leave a nice renovated property. So you've got a vacancy reserve of 13,500, and we've also got a maintenance reserve of 13,500. So when we multiply that, when we add this together, that's $27,000 of additional money that is sitting in your reserve funds, and if you haven't used it, that is just sitting there. Oh, but hey, hold on a minute, Gord. What about the appreciation factor? Well, so for this chart, which includes an appreciation amount, we're going to start at and I'm just rounding it up a little bit, $550,000 purchase price. Okay. So we're going to use a very small appreciation factor of 2% year over year. Then we're going to show you the new value in this column after each year. Then we're going to show you the equity and the cash flow, which we've already determined from our previous chart. And then we're going to add these together with the accumulated 2% gain. And we're going to get a number here in this column. And then when we divide this ultimate number into our 135,000, we get what I like to call our deluxe ROI. Make sense? Okay, so let's get into some numbers. I get so excited at this. So we've got our $550,000 purchase at 2% appreciation. So first year, the accumulated gain is $11,000. Giving us a new value of $561,000. Our equity and cash flow in the first year totals $15,451. So when we add this to our appreciation, we get $26,451. And when we divide this into our initial capital injection of $135,000, we get 19.59% deluxe ROI after the first year. And just like the last chart, I'm going to let this expose this all at once. So accumulated gain, 22,220. The new value of 572,220. Equity and cash flow, 31,298. And when we add this to our 22,220, we get 53,581, giving us 39.64%. And similarly, when we do the same thing in column 3, we get an ultimate total of 60.15%. The end of year 4, we're at 81.48%. And at the end of year 5, so we have to know that at the end of year 5, we've got an additional $58,120,000 of accumulated appreciation gain. And again, that's a conservative 2%, right? Our new value is $630,340, right? So our accumulated cash flow, equity cash flow and appreciation is $139,496. So when we divide this into our $135,000 initial cash and capital injection, wait for it, we get 103.32% deluxe ROI. So now you've made more than your initial investment. Pretty cool, right? But wait, it gets better. How do you cash out of this? This leads me to step 6, cash out and refinance. And this is an amazing part of this whole process. So we've got our at the end of year 5, we've got 630,340 as our new value of what this property is worth. Okay. So now we take that money, that value rather, and we can refinance that to 80% loan to value. So what does that mean? That means we can get a new mortgage of $504,272. Okay. Remember, our 5-year mortgage balance, we've paid it down to $379,614. So when we refinance this, we can get a cash back, a tax-free, hear me, tax-free cash back of $124,658. How much did you put in the property initially? $135,000. So guess what? You own this property with only $10,342 left in the property. How cool is that? And now you've got $124,658 in your pocket to do what with? David, you got to help me out here. What would you do with that money?
More real estate. This is what this webinar is all about. You know, Gord, I'm sitting here looking at these numbers and I have a big smile on my face. First of all, we didn't factor in rental increases, right?
That's correct. Yeah.
You can do rental increases. Number 2, show me a market in the GTA that has had only 2% real estate appreciation. It hasn't happened. Historically, Gord, what do you think is a more relevant number?
Well, I mean, lately we've seen, you know, a real run up everywhere in the GTA, right? So, and quite frankly, in most major centers across the country, but in the GTA, we've seen, I mean, 6-8%, right?
Year over year, consistently.
Consistently. So
right.
I'm just doing this, like David said, as conservatively as possible, just to show you that even when you're super conservative, these numbers, I think, are pretty exciting.
Yeah, I couldn't agree more. And really seeing the numbers on paper really brings them to life and makes a huge difference. I know that that happened for me personally when we first started analyzing numbers together a couple months ago. Led me to buy a few investment properties as well for myself. So I'm super excited to be sharing this with everybody, and I can't wait for more of the analysis to come.
All right, so yes, we're not done here. So what do the next 5 years look like? Well, let's say you want to buy a property and you're going, but I don't have any initial money. I don't have that initial $135,000. What am I going to do? Well, I have a solution. So let's go back. This is, sorry, I need to get back to this. Yes, sorry about that. How to use the equity in your home to invest in real estate. Because there is, if you have owned a home for 5 years or more, guess what? You have equity, and you can use that equity to your advantage. So again, you may be saying, I don't have that 135,000. So here's what we're going to do. You can use the equity in your home, use this as the initial capital to buy a property, and this is called a HELOC, or a home equity line of credit. Now you can access up to 80% of your current home equity. And this line of credit will charge you interest monthly, which is tax deductible, but check with your tax professional. But don't worry, you can use your positive cash flow on the property you buy to offset the interest payment. Okay, you see what's happening here? So when you do that, you are actually buying a property using none of your own money. You're buying it no money down, right? So what is the return on investment on this? Well, it's infinity, right? So do you have to buy property this way? No, but it's an amazing way to get into the investment market using the dead equity in your home. So this leads us to step 7. And that is, I really hope you learned something in this presentation that has excited you. And I'm still excited, and I've been in investment real estate for the past 32 years. And I highly recommend you to discuss an action plan with the realtor who brought you here tonight, and then put your plan into action. And I just want to say something about your realtor, and you must know this. All real estate agents are not created equal. And after having hundreds of miserable experiences with realtors in both Canada and the US, who do not understand investment real estate, but telling me that they did, I got to the point where I created a training completely dedicated to realtors to help them understand how to really understand investors, understand real estate investment properties, and the needs of real estate investors. And the realtor who brought you here tonight is special, and I'll tell you why. They have the SIR designation, which is Sutton Investment Realtor. They know what we've discussed here tonight and much, much more, believe me. They've gone through my training, and I would be happy to have any one of them to be my agent now. And the Sutton Summit Brokerage, who's hosting here this evening, has 35 years in business. And unlike most brokerages, they actually have systems in place to support their realtors in their businesses, which is amazing. And you have to understand that in real estate, it's time in the market, not timing the market that counts. And I hope I've showed you the power of real estate and the benefits of just simply getting into the game and being able to enjoy the benefits and wealth building that the power of real estate actually has. So I encourage you to take the first step and talk with the agent who brought you here tonight, and work together on your plan for you to build your dreams, your wealth through the power of real estate. So on behalf of me, Gord Lemon, and the Real Estate Training Club, I just thank you for being here, and I'll turn it over to David.
And on behalf of Sutton Summit Realty and your Sutton Summit agent, we wanted to thank you as well. Super excited about real estate investment, and as is your Sutton Summit real estate agent. We have the experience to really help you and guide you on this journey, and it's all about taking that first step. So I hope that by seeing the numbers, by seeing the analysis, you're as excited as we are. And please get in touch with your Sutton Summit agent and start the journey. It's all about taking that first step. And I wanted to commend you, because coming here to this webinar is already taking the first step. So keep going. Don't stop now. It's time in the market, not timing the market. And over a 25-year period, even if the market were to do a 50% price correction, I guarantee you that you would have over 150% return on your initial investment after a 25-year period. And I encourage you to sit down with your Sutton Summit realtor and ask him, challenge them, say, my realtor, show me, if the market does a 50% price correction, what are the numbers going to look like? And I guarantee you, you are going to be shocked and surprised by what you see. And if that doesn't convince you to jump in, I don't know what will. But this really is the best way to build wealth. Whether you want to retire early, whether you want to quit your 9-to-5, whether you want to have more luxury time with your family, investing in real estate will accomplish all that and more. I guarantee it. We're very, very, very passionate about this. We're going to be doing these webinars once a month. And Gord, maybe the next one we do, we're going to show an example of what will happen over a 25-year period with a 50% market correction and show you what those numbers look like. So stay tuned. wait for an invitation from your Sutton Summit Realtor, and we're happy to show you all those numbers.
Happy to do that. Yeah.
Does anybody have any questions? So we have one question from Abu, and he's asking, do we consider taxes on the income, on the cash flow that's generated from properties? How does that impact our bottom line?
There is, so in real estate, as I mentioned in that tax aspect, there are lots of write-offs, and it depends on your personal tax situation, because you can be buying property in your own name, or you can be buying it in a company name. And so depending on how you are set up, that answer will differ. So, and just to expound on that and sort of go a bit sideways on that, having an accountant that actually understands rental real estate, and this might not, sad news for you, it might not be the accountant that you use right now. And I personally really accentuate having an accountant that's actually owned a rental property, and they're not just checking the tax code for what can be written off, but actually have experienced it, because there's an intrinsic knowledge that goes with actually owning rental real estate. So, and those accountants are out there. So, and those will do the best for you and be able to, obviously decrease your tax burden as such, and be your a good team member for you as you move forward, and you want, if you're looking to build a portfolio in real estate, it's good to work with a great tax professional right off the bat, and having his expertise to be able to suggest a way for you to be able to grow in the most tax efficient way.
Absolutely.
I
always say that, having income tax payable is a good problem to have.
It is a good problem to have, but, and I know people are like, oh no, I don't want to pay any more tax, but I mean,
that means you're making money.
It means you're making money. Yes, exactly.
Right? So, I mean, part of that issue is making sure that you do have a good team on your side. And I think having an accountant that has experience with rental properties is absolutely fundamental.
Mm-hmm.
So I'd like to thank you guys once again for coming and for joining us this evening. And I hope you guys are as excited and as passionate as we are about real estate investing. So on behalf of Sutton Summit Realty and the Real Estate Training Club, I'd like to thank you for your time today, and we'll see you next time.
Take care.